All right, let's dive into a fascinating story that starts out with a pretty standard, even boring piece of paperwork, a tax refund. But believe me, it spirals into a massive billion-shilling legal war. We've got a global tech titan on one side, a national tax authority on the other, and the whole thing, well, it all comes down to the meaning of a single word. So here's the question that really kicks off this entire saga. How on earth does a routine tax refund request for a fairly modest sum, just under 25 million Kenyan shillings, somehow morph into a tax bill for over 1 billion shillings? Yeah, you heard that right. That's a jump of over 4,000%. So let's get into how this happened. Okay, so let's rewind the clock. Our story really begins with what seemed like a totally normal business filing, all the way back on November 21st, 2016. On that day, Google Kenya put in a claim for a VAT refund. Their whole argument was pretty straightforward, right? They said the marketing and R&D services they were providing to their parent companies over in Ireland and the US were technically exported, and because of that, they shouldn't have to pay local value-added tax, or VAT, on them. Simple enough. So, everything, and I mean everything in this case, hangs on this one specific term: exported service. Now, under Kenyan law, this means a service that is used or consumed outside of Kenya. If you can prove that, the service gets zero-rated. And that's the key. It lets the company, in this case Google Kenya, claim back the VAT it paid on its own business expenses. This is the entire logic behind their 24.9 million shilling claim. But as you can probably guess, the Kenya Revenue Authority, also known as the KRA, they saw this very, very differently. And their response wasn't just a no, it was something that would blow the whole thing wide open. Yeah, the KRA didn't just deny the request and call it a day. Oh no, that little refund claim basically set off a fire alarm, triggering a full-blown audit into Google Kenya's books. And what they dug up completely flipped the script. Fast forward to June 25th, 2020. The KRA drops its first bombshell. They don't just deny the refund, they hit Google Kenya with a brand new tax bill for over 150 million shillings. Whoa. But they weren't done, not even close. Just a couple of months later, on August 5th, 2020, another assessment lands. This one is for almost 909 million shillings, and now it includes a whole bunch of penalties and interest on top. So let's just pause and look at this escalation. It's kind of wild. It starts in November 2016 with a 25 million shilling refund request. By April of 2021, it has completely exploded into a confirmed tax debt of over 1 billion shillings. Just an unbelievable turnaround. So how did we even get here? Well, it all comes down to two completely different ways of looking at one simple word: consumed. Okay, so the whole fight really boils down to this. On one side, you have Google's view. They're saying, look, the consumer is the one who pays the bill. That's Google in Ireland and the US. Simple. So the service is consumed outside Kenya. But then you have the KRA's view. They argue, no, you have to follow the benefit. The marketing you did was aimed at the Kenyan market, so the ultimate benefit and therefore the consumption happened right here, inside Kenya. So both sides dug in their heels and took their arguments to the Tax Appeals Tribunal. This really set the stage for a classic legal showdown: the letter of the contract versus the context of the business. So Google's case was built on a foundation of contracts and international standards. They pointed to their formal signed service agreements with Google Ireland and Google US. They argued, hey, this is how it's done everywhere. It follows the OECD guidelines, which is basically the international rulebook for this stuff. They believed the contract is king. Now, the KRA's counter-argument was built on a totally different idea, a very strict, very literal reading of Kenyan law. They leaned heavily on this classic legal principle that basically says, when you're looking at a tax law, you don't guess, you don't read between the lines. You just look at what is clearly stated, and that's it. So what did that mean in practice? Well, the KRA's argument was all about the real-world effect. They asked a simple question: what was all this work for? And they concluded that the marketing, the research, it was all done to benefit the Kenyan market, to get more people in Kenya to use Google's products and services. From their perspective, a private contract between two parts of the same company can't just override the basic facts on the ground. All right, so you've got two strong but totally opposing arguments. How did the tribunal decide? Well, the answer, funnily enough, wasn't something new. They found it by looking in the rearview mirror. The final judgment, which came down in 2021, was a decisive win for the KRA. Google's appeal? It was pretty much dismissed across the board. So why did they side with the KRA? Well, the tribunal's reasoning didn't invent some new legal theory. Instead, it was all about one thing: consistency. And the key to that consistency was a case they had already decided a few years earlier. You see, there was this earlier case, the Google case of 2017, that was basically a carbon copy of this one. It had the exact same parties, Google Kenya and the KRA, making the exact same arguments about the exact same issue. And because the tribunal had already ruled back in 2017 that these services were consumed in Kenya, they just followed their own precedent. It was like deja vu. And just like that, the billion-shilling bill was upheld. Now, the tribunal did throw Google one very small bone. They found a minor calculation error in the carries math and knocked about 3.2 million shillings off the total. A tiny victory in a much, much larger defeat. So why does any of this matter? Well, this ruling sends a really powerful signal. It's telling multinational companies that, in Kenya at least, your contract with an office in another country might not be enough to prove your services are exported. Tax authorities are more and more willing to look past the paperwork to see where the real economic value is actually being felt. And really, this whole case leaves us with a massive question for the future. We live in a world now where digital services just don't care about borders. A service can be created in one country, paid for in a second, and benefit a market in a third. The old rules for taxation just weren't built for this. And this case, right here, is a perfect snapshot of a global challenge that pretty much every country on Earth is trying to figure out right now.